I'm Eric Mattei from matteirealty.ca. Welcome to another installment of Wednesday Wisdom. This one deals with a fairly serious matter, and there's a lot to digest. So, Carolyn Rogers, the senior deputy governor of the Bank of Canada, addressed the Economic Club of Canada in November of 2024, and the discussion involved the mortgage wall. So, what's a mortgage wall? If you haven't been following up on this, it's something you should know about if you have a mortgage or you're a homeowner here in Canada. According to Carolyn Rogers, 60% of all outstanding mortgages, 60%, will renew over the next 2 years. More significantly, the bulk of them were not subject to any type of renewal since 2022 when the rates began to rise. Even with the decline in rates, there's still going to be an impact on those households. From a monetary perspective, Carolyn Rogers, remember, she's part of the BOC, the Bank of Canada, says that households will continue to adjust, pay attention to those words, their saving and spending patterns, which means they're going to be stuck with a lack of disposable income, if you want a translation. And as interest rates come down, that impact will fade and consumption will gradually pick up. Now, I always say when someone asks for appliances to be in good working order, good is a really subjective word that poses a good question for a judge to decide in court. Working order is something entirely different. To say that the market will gradually pick up is not an accurate representation that it'll happen overnight, just as quickly as it could fall, for instance. Now, if you want another perspective, David Rosenberg, Canada's menacing mortgage math means crisis is looming. It's a Financial Post. Bank of Canada will need to cut rates to prevent slowdown from becoming a meltdown. This is also from November of last year. Now, in this article, David Rosenberg states, we confirm that two-thirds of mortgages by value will renew by 2026. The amount is backloaded with about half, just over half between 2024 and 25 renewing, with the remainder in 2026. In February of 2022, there was an average mortgage payment of $1,460. It's now above $1,900. It's a 30% increase according to CMHC. Now, of course, BOC understands what's going on. I would hope that there's people there who are well qualified, more so than I, to understand the market, and they've addressed dropping rates now. But what this basically states, according to Financial Post, with these jumps in costs of housing, there's a 20% reduction in extraneous money for disposable income. That's a huge impact on the economy for things like cars, clothing, going out for shopping or groceries or other items that are extravagant as a disposable income, whatever you qualify that for. What options does a household have? They can restructure their payments. So if you have capital that you can put in from your savings into the mortgage, it can lower your monthly payments. That's one option. Excess savings now could be pulled back towards maintaining debt. Again, that will have an ancillary effect on the remainder of the market. Other households, say senior citizens that have been waiting to do so, will downsize to lower their debt. And if some of you are thinking, well, at that age, why do they have a mortgage? Remember, we had 30 and 40-year AMs. Okay, if you bought a house when you were 45 or 50 years old, do the math. If you have to help your kids get married or find a home, do your math. So if they want to eliminate their debt load and downsize into a condominium or outside of the GTA, that will also have an impact on the surplus of supply on the market, driving prices further down. So one thing to note, they do mention in this article, David Rosenberg from the Financial Post, that there's a 2-year lag between mortgage defaults and the changes here. So, I would hope that if the rates continue to fall, we can avoid a massive defaults, hopefully. The one thing to keep in mind, there's $1 trillion of renewals that are due by 2026. That's a huge demand that could happen to the market with the surplus of supply that comes on. So it's imperative that that's dealt with by dropping rates quickly. Those of you that bought in the higher markets, you did so on the advice of your government, who said that rates would not rise. It's not for you to blame. This situation has to be rectified, and keep in mind why the rates went up in the first place. Your government printed money like it was on a Xerox machine in the basement. That is the repercussion that we're facing now, where inflation is run rampant and we're trying to control that with those rate hikes. The Bank of Canada did what they had to do. So here we stand in front of a wall, and hopefully, with the right decisions that are made in the next little while, we can avoid an oversurplus of supply in the real estate market, and more significantly, any defaults. Nobody wants to see a family lose their home. If you're considering making a change, this type of information is imperative for you to consider your timing, because at some point your neighbors and their neighbors may decide to sell in order to deal with this debt load. Before that, you might want to beat the rush to the amount of supply that's out there. I don't have a crystal ball, but it's something for you to consider. So keep in mind, this is still a fantastic country. In spite of the warnings from our neighbors to the south, this is still one of the most incredible places to live, tariffs or otherwise. Canada is still the envy of the world. It's a beautiful place to own a home and raise a family, and that won't change. Please do keep that in mind. Not everything is doom and gloom. Have a great day. If you have any questions, you know where to reach us. info@matteirealty.ca, 416-557-SOLD, 416-7653. I'm Eric Mattei from matteirealty.ca. Have a fantastic day.